the insane rise of UK house prices in the last 20 years and even before that, is it better to keep your money in a rental property, or is it better to keep your money in the stocks and ETFs kind of side of it? Houses double every 10 years and it's been insane the amount of millionaires that have been made from the housing market in the UK alone. But is it too late now? Is the barrier to entry too high? Are the house prices too high? You're not getting the rental yields you used to before or once could 20 years ago? I'll explain all of that in this video. We'll also chat about the ROI you can expect to see in a rental property, anything you need to be thinking of or be aware of when you're looking at this as an idea to invest in, and how this compares with the stock market, and would it just be easier to leave your money there? Ready, kids? Alright, so we've got to think about it in terms of an ROI perspective. How much are we making on a rental property? A huge factor in looking at properties is the location specifically. It doesn't really matter about the property, you need the location. We're going to be looking all over the UK. I'm going to assume that you just want the best property. You're not looking for anything that's close to you, which is ideal because there's probably not many investment properties that are around near your mum's basement. Right, so what does the ROI look like for these houses?
$100 billion.
Well, it depends on the area. To measure this, we're going to look at the rental yield of houses. Now, there are two types of rental yield. There's the gross rental yield, which is the annual representation of what you're getting from the house, so the rental income coming from the house obviously is expressed as a percentage. And then the net is the same thing, except you're going to minus all the costs it costs you to run that and maintain the property. As a benchmark, the average rental yield, and this is gross rental yield, is 5.49% in the UK, with the average buy-to-let property costing about £262,000 and an average rent of £1,200 per month. On screen now is the top 10 best places you can look at when you're looking at a rental property. The general rule when you're looking at all of this stuff is if you want a good rental yield and rental property, you should probably be looking up further north in the UK. When it comes to regions, you'll be able to see this chart here. Again, a lot of it is the north. Obviously, Wales isn't the north, but you know, it's very much a northern game here. Area-wise, we can see the north is definitely better to be renting in or buying a house to rent out. And this is great because northern prices are also much cheaper. The house prices up there are much cheaper than like you'll get in London or in the southeast anyway. This is important because for a rental property, you're going to need to put 25% of the list price of the house down as a down payment. And the rest you're going to finance, and it's going to be financed not on your income like a residential one, which is usually like 4 times your income. It's instead going to be on the rental yield of that property, or projected rental yield if it's not been rented out previously, or look at what does a 2-bed home in that area go for usually. So let's have a look at an example because I feel like this is all kind of airy-fairy, but let's actually look at a house and see how it would work. So I literally just scrolled a couple times until I found this house. This was just on Zoopla, which is one of the ones listed. This is not a rental property, but it could be one. This is a 2-bed cottage in Sunderland. Now I chose Sunderland because that was one of the ones that was top for the rental yield if you saw before earlier. So we'll use this as an example so you can see the math behind how the rental yields would work. So the house is 85 grand and that's for a 2-bed property. According to this, your average rough price of a 2-bed place in the rent out will be about £540 per month, but we'll just say 550 to make the numbers easier. So if we do that and we say 10% is going to be put towards maintenance and stuff, so it's going to be a light year. There's not going to be much heavy stuff going on. You're not doing any boilers or anything like that. There's 2 ways you can mortgage the rest of the balance that is due on this house. You can either do an interest and repayment or just an interest only mortgage. Now, a lot of renting properties, they use just interest only because it cash flows a bit easier. As you can see here, the mortgage cost, if I was paying the principal down as well, would be £282. If I'm just paying the interest, it's £70 cheaper per month.
Okay, so let's calculate the cash flow of what this house is going to look like. So we know we're getting $550 per month in rent. That's definitely coming in. We need to now minus all the expenses we're going to have. So obviously we put repairs as £55 here, so let's just pop that down. We now know the mortgage payment is going to be £212, and that's interest only. So at the moment we're left with about £283 in profit, and that's every month. But this isn't including if you wanted someone to manage the property or any insurances and stuff like that. So if we take off, let's say the £83, so we say £200 in profit, and that will allow us to have everything managed for us and all the insurances and everything we need, basically. So the property cash flows £200 per month in profit, which is about £2,400 per year.
So how does the maths work on the front end? So you're going to need to put 25% down. So in our case, that's about £21,500 plus another £2,000 for taking the mortgage out and like fees and stuff like that. So roughly all in, we're about £23,200-ish. So
let's calculate the yields now. So we know that we've just spent £23,250 on this house all in. So that is the mortgage and the legal fees. Now, if we want to calculate the gross yield, what we're going to have to look at is how much do we get from the house, which is £550, times that by 12, because we're going to look over the year, what's the return on the year. So that'll be £6,600 you're bringing in from the house. No expenses or anything. Remember, this is gross. And over the house price, which is £85,000, equals 7.73%. That is gross. Now, if we want to find the net, all we do is basically the same equation as that, but instead of putting the total like money we're getting in, we just put our profit. So we know the profit was 2,400. per year, and we know 85,000 was the house price with 2.82% net. So that's what you're taking home and walking away with. If you want to find the ROI, all you got to do is look at the initial amount you invested, which is this number here, and then just put the profit that you made over it. So you do 2,400, which is the rent that you're making per month, per year, and then 23,250. So your ROI would be 10.3% for that year and every compounding year, assuming that you don't put the rents up and you make the same amount of profit every year and every month.
Add on top of that the appreciation of the house. Now, this isn't a very expensive house, but if you were getting more and more expensive, the 2 or 3% that house increased that year would be quite a significant sum. So how does this compare with other assets? I'm not going to compare it to bonds or high interest savings accounts because they will lose to the stock market or rental properties. It's just the interest rate is too low, so I'm not going to talk about that. Really what we want to compare this to is the stock market, because you can put your money in the stock market and it'll give you 8% pretty much religiously year over year. Stocks are actually technically a little bit better returning your money than rental properties as a whole. Stocks double every 8 years. The S&P will double roughly every 8 or 9 years, whereas property prices are doubling every 10 years. So it is a little bit better to do stocks. But houses have the added benefit of leverage. You'll have a mortgage, so the house price will be much larger. You're moving, doubling of, instead of just your capital of say like 10 grand, you put that 10 grand into a 100 grand house. You've got that 90 grand of leverage that you're getting that doubling on over the next 10 years, if that makes sense. Depending on the property and how much headache and heartache and hassle you want to put into it, it can actually be significantly better to get a rental property compared to the 8% in the stock market. Now, there are a lot of other implications I would recommend you look at, specifically as well tax. If you get the rental property, that income will come to your name. Unless you put it under an LLC, you'll be taxed on it as income to you, which may not be ideal and maybe push you up into upper bands that you don't really want to be in, and you can't really control that unless you put it in an LLC. So it depends. You'd have to look into it for your tax situation for you specifically. Whereas stocks, you'll leave your capital in and it will appreciate over time, because remember the Bible says stocks always go up, and because you're not selling anything, you're not actually paying any tax. And then when you do sell, if it's in an ISA or anything, you wouldn't pay any tax anyway. There's a lot of responsibility of being a landlord, and you can outsource this usually to like a property or estate agent, and they will manage the house for you. Obviously for a fee, usually it's a percentage of the rent, but remember this will also eat into your profit, so you're gonna have to think about that. Again, if it's in an LLC, that is actually tax deductible, but still. Also, it is time consuming. If a boiler breaks or something goes wrong, you need to you're gonna take the call. If you've got a property manager, that's a different story, but if you're doing it, you're gonna need to put some more time and effort, whereas stocks, you can just put it in and forget about it. Also, if you're looking at buying a residential property after you've bought your first buy-to-let home, it could impact your affordability score on that property itself, because your rental income will be higher, and there'll be other factors. It kind of depends on you and your situation, but just know it can affect if you want to buy a residential property later down the line. Also, just be careful if you're a first-time buyer. Sometimes lenders can be a bit iffy because you've never managed a mortgage before. They will still lend to you if you qualify for everything and the house makes sense, but just keep that in the back of your mind. Now, if property really isn't your thing and you want to explore a different asset class, I've done a video on crypto that I think can really help you out. If you watch this now, you'll see everything you need to know and see how you can make 2, 3, 4, 5x gains potentially.